Greetings, everybody. It's been another messy month in financial markets. There's a lot to cover. I've got some good graphs. This might run a little longer than usual. So without further delay, let's get into it. I did change my lighting, so give me feedback on that. My mother told me my past lighting was not very good. So I'm trying a brighter backdrop. Hopefully that helps illuminate a little better. So let's get to the graphs. And you should see my screen. April commentary. Again, this is just a collection of graphs that I find interesting. There's no shortage of things to talk about, that's for sure. So looking at the broad asset class performance, this has been a year where there's been very few places to hide. And you can see on my screen, going from on the left, bottom left there, starting at 20-year treasuries and making your way to the right, tech stocks, small cap stocks, emerging markets, international developed countries, the S&P, total bond market return, so on and so forth. There's been a lot of red. The only places to hide, and we'll get into this a little later at the factor and sector level, has really been commodities on the asset class level. So gold, obviously energy, and name your commodity in the face of supply shortages. You know, the war didn't help. So that has caused dislocations across the commodity space and really has caused prices to rise. So this has been one of the few years where a multi-asset class framework being diversified has not worked. And there's very few free lunches in investing. And I think that diversification is one of them, meaning if you own several different asset classes, that can help smooth out the ride. This is one of the few years where that has not been the case. It doesn't happen that often. The last time it happened was 2018, but it was on a much more muted basis. We weren't seeing these wild swings, especially in the bond market. So if you're wondering why your bonds aren't offsetting your equity risk, your stock risk, this is why, because everything is down. And this is just another look at kind of the journey. So this is the start of the year. And the red line is long-term treasury bonds. The light blue line is the S&P 500. And you can see to start the year, these two were tracking pretty closely. The S&P got off to a pretty ugly start. And then as the Fed started to change their rhetoric, they started to talk up a quicker pace of interest rate increases that really caught the markets off guard, especially the bond market. Of course, as interest rates, as bond yields rise, bond prices go down, and you really saw that move lower in longer dated bonds here. And then, equities kind of hung in there, and these two actually flipped where bonds were performing worse than stocks. And that's where we currently stand. But you can see equities are trying to catch up here. And, a lot of people expect this gap to close or even flip again, which we don't make predictions. But, it'll be interesting to see. And we'll get into what the Fed and what markets are actually pricing in for Fed hikes right now. It really is quite aggressive. But the good news is seldom does Fed action line up with what the Fed says. So they're really talking up interest rate increases. I would be very surprised if it went according to their script. And that's because the data is always changing and financial markets are always changing. So this is a graph of S&P price since April of 2017. So roughly 5 years of data. So the light blue line is the S&P. The burnt orange line is the PE ratio for the S&P. And you can see the PE ratio is in this y-axis, and then the S&P level is on this y-axis. So, if we're looking at PE, we're looking at this axis, and you can see when prices go down, right? This is the price to earnings ratio. So price divided by earnings, the P has gone down in 2022. The E is still hanging in there. So earnings have still been decent. And we're in the middle of earnings season right now, and that could change. But up to this point, earnings have been decent. The P is the one that's been deflating. So if you're a fan of PE, and I know a lot of people are, one, this is forward PE, so not what earnings have been, but what they're expected to be over the next 12 months, this has come down. And this is actually, if we look at the pre-COVID level of 19.5 on the future PE or forward PE, we're actually below that now. So if you're a bargain hunter, or if you're not a fan of buying stocks when they're at these multiples up here, there could be pockets of value now, given that many stocks have sold off fairly aggressively. But you can see that we're still we're still somewhat elevated on a historical sense. I believe the average forward PE is about 15. We're at about 18 and a half as of this recording. I'm recording this on 4/26 of 2022, and you can see, the sell-off that we've experienced really starting in the fourth quarter of last year going into this year. Now, you can't talk about the S&P without talking about the mega cap tech companies, and I think this is a pretty cool chart. We've spoke about the sheer size of large tech being the biggest headwind to their growth, right? So we own some of these companies. We like these companies, but I think you need to distinguish between what a stock is trading at and the underlying business. Like, you can have a great company, and that doesn't necessarily mean it's a great investment, if that makes sense. Because, right, we're paying for future cash flows. What a company is currently trading at does matter as far as future returns go. So the more you pay up for a company, the more that has to go right. What you're seeing for these companies, as interest rates move higher, that's kind of taken some of the steam out of them. And again, a lot of these companies were trading at frothy levels. So what this is this shows the size of the company at the start of the year. So the bigger the circle, the bigger the company. You see Apple, Google, Amazon, Microsoft, Facebook, and Netflix. So Apple's the biggest company out of all of these, okay? This is the year-to-date change. So this would be positive, this would be negative. So anything left of this zero-bound line is a negative return so far as of this year. And then this is really interesting. So this is the contribution to the S&P 500 year-to-date return, okay? So the bigger the circle and the bigger the negative change, the bigger impact that it's going to have on the S&P, okay? So let's just take a look at Microsoft, all right? This is probably the second biggest circle here. And Microsoft is down, let's say 14% for the year. And we go to the left, we drag our mouse to the left. That has produced a roughly negative 0.7% return on the S&P, right? So this has contributed to negative 0.7% out of the total S&P return for this year, which is the S&P is down about 10% as of this writing. So Microsoft is almost 10%, right? If we round this up to 1%, 1% of 10 is 10%. So Microsoft does a lot to explain the returns of the S&P. The same thing for these other big tech companies. As you get a bigger circle and as it gets more negative, as it moves more to the left, that's going to add more to the negative returns to the S&P. So Apple, Amazon, and Google have all contributed about negative 0.4, negative 0.3% to the S&P's year-to-date performance. Facebook, as you can see, so this is another good example. Although the circle's smaller, right? Facebook is a smaller company than Microsoft and Apple. It's down over 40% this year, and it explains about negative 1% of the S&P's return. So the influence of these big tech companies is very large on the S&P 500. And look, it's not unusual to have 5 or 6 companies explain a good chunk of the S&P's performance. If you look back at history, it's very common to have a handful of companies that make up a good chunk of an index. What is rare, and what we've talked about a lot over the years, is the players at the top, the big names at the top change, right? So maybe if we fast forward 5 or 10 years, there's still going to be 5 or 6 companies that are making up a good chunk of the index and explain a good chunk of performance. But instead of Amazon, instead of Apple, it might be a different company, a company that we haven't even heard of yet. So that's why we say, when people are shoveling money into these companies, expecting 20, 30% a year, the odds of that happening are very small. This looks a little messy, but I can explain this. Okay, so this might be some chart crime here. But so this is a basket of the Russell 1000, which is basically 1,000 of the largest stocks in the US. Okay, so this covers large, mid, small size companies. And in the left column here, we have several metrics. So market cap, size, dividend yield, price to book ratio, price to sales, price to earnings, international revenues, okay? And then moving from left to right, we have a decile ranking, okay? So let's just take an example. Let's look at market cap. So in the first decile, that's the smallest companies. And in the 10th decile, the furthest one to the right, this is the largest companies. Okay, so let's just go through a few of these because I think this is useful to show you what factors are performing well and what factors are performing not so well. So you can see smaller companies tend to be performing better than larger companies. And there's various theories for this. Smaller companies tend to generate most of their revenue in the US. And as you can see, companies with international exposure, right? So again, international revenues, the first column here, the first decile here, companies with the lowest international exposure. So this decile might feature companies that do business exclusively in the US. And on this end, companies with the most exposure to global trade and to global sales are doing worse. Okay, this might be due to supply chain issues. This might be due to less demand. So this could be a combination of factors. It's too tough to say because every industry is a little bit different. But so this is very useful. And this is perhaps the biggest, well, there's two that jump out to me here. One is the price to earnings ratio. So the cheapest companies so far this year, or this is actually as of last November, the cheapest companies as of last November, right, with the PE, the lowest PEs are performing better, right? So this neighborhood here. Look at the companies with the frothiest PEs, meaning the most expensive companies. So when I look at this makes for a consistent story. Tech is absolutely getting wrecked, especially the COVID work from home themed stocks, right? So that the froth has come out of them. And the more old economy stocks, the dividend payers, which you'll see here, dividend paying stocks, energy, financials, defensives, industrials, which tend to pay dividends, which tend to have lower PEs, are all performing better, right? So that's this green area here. So lower price to sales, lower price to book, lower PE. So price to book and price to sales are just different flavors on how expensive a stock is trading relative to their book value, relative to sales, and relative to earnings. So long story short, expensive stocks getting wrecked, tech getting wrecked, old economy, defensive dividend payers like utilities, you throw real estate in there, are performing much better. I just threw Bitcoin in here too because one, Bitcoin is a emerging asset class. A lot of people, a lot of pro Bitcoiners, if that's a term, say that Bitcoin could be a hedge against inflation. And I think it's too early to draw any absolute conclusions off of this. Why I included this is every asset class is down. Bitcoin is not alone in this. As an inflation hedge, I think, again, it's too early to say, but year over year, I think Bitcoin is down over 30%. And if you're looking at this when inflation's a thing, you can argue Bitcoin hasn't really been a hedge against inflation. But I like Bitcoin. I think it's interesting. Look for a webinar coming out soon about pure portfolios, venture into digital assets, and where we think that might make sense for some folks. And I've already done a podcast on it too, so check that out as well. So not to get political, but this is a midterm election year. Okay, so we want to look at how midterm election years stack up versus all other years, meaning years that don't include midterm elections. And we're not talking left or right, but we're just looking at the evidence, looking at what markets have done. So this data set is between 1946 to 2021. You can see the yellow line is the S&P performance as of this recording, which this chart's actually from last Friday, which is what, the 21st or 22nd? I think the 22nd. Okay, so this is 2022. This red line is the average of all midterm election years. Okay, S&P performance during midterm election years since 1946. Okay, so it's a little lower than these other lines. And then the average with all years. So every single year between 1946 to 2021 is this blue line. And then when you strip out midterm elections and capture all the other years, so we're getting rid of this data set in here, and returns are higher still. So this is every year stripping out midterm election years. This is all years, and this is midterm election years. So there's a clear trend, and I'm not saying this is going to happen this year. There's certainly other factors that have nothing to do with midterm elections that are impacting stock prices right now. But on average, over the last, 60 years, 50 years, midterm election years tend to be worse. Everybody's favorite topic, the Fed. So let's Let's look at the futures market and see what the futures market is pricing in, okay? So this is the expectation based on market forces. So this is not what the Fed is necessarily saying with their rhetoric. This is what the financial markets are expecting the Fed to. And again, back to my opening comment, just because the market is pricing this in, that doesn't mean this is what the Fed is going to do. This is just the market's best guess. Okay, so this is where we're currently at. The Fed hiked by 0.25% back on March 16th. The Fed funds futures pricing calls for a 0.5% hike in a week or so. This is what's interesting to me, and I think this is a little absurd. The market is pricing in a 0.75 point hike in the middle of June. This would be unprecedented, in my opinion. To me, this is overshooting. It wouldn't surprise me if this is 0.5%, but I think 75 basis points or 0.75% is a little ambitious. And you can see we go to 50 in July, and then 25, 25, 25, 25, and 25. So the pace of hikes is aggressive at the start and then kind of tapers off at the end of the hike cycle. So this is basically a year from now, and this would put us, let's see, to about 3.5%, right? So the Fed would be tightening by 3.25% between now and the next year. Again, I would expect this to be aggressive at the start and maybe to flatten out here, or even the Fed could start cutting rates if they get a surprise. So if we get lower inflation, if the war in Ukraine stops and they get a ceasefire, if something else happens, this could quickly change. This is highly data dependent. This is just what the market is pricing in now. So I pay more attention to that. When we talk about taking our cues from the market, this is what we're talking about. So I'd rather pay attention with how investors are voting with their capital rather than listening to a talking head on TV or reading Barron's or Bloomberg or whatever. Okay, so this is basically taking that last slide and just comparing it to historical levels of Fed funds rate and the change in Fed funds rate as we move through time. So this is as of 1982 to today. And you can see how if what we just saw happens, if the Fed hikes by 3.25% over the next year, this is where we would be relative to history. So we roll this back to the 80s, which everyone likes to talk about. If current Fed policy is consistent with that last slide, this would be a very aggressive cycle, consistent with previous cycles where the Fed really worked to nip inflation in the bud. So let's look at some economic activity and expectations. So the Beige Book is a economic survey, essentially, that's published 8 times a year, I believe. And what this is basically a polling of data, surveys across 12 distinct districts across the country. And it actually tracks pretty closely to GDP. And what this is telling me, so this is as of April, and this goes back to 1996, but economic activity is still robust, okay? So there's been a lot of recession talk, and certainly if the Fed is super aggressive and they're hiking, that could trigger a recession. That's happened before. But as it stands now, economic activity is still running pretty hot. And as we'll see from the next slide, this Beige Book and GDP tracking is consistent with 5% GDP growth as it sits now. So this is GDP growth on the right. This is the Beige Book index on the left, if you will. And you can see the dark blue, this Beige Book survey, and this light blue, which is GDP growth year over year, run very closely together, right? So this Beige Book is shooting higher. I would expect GDP growth to track very closely with this. It does come unhinged on occasion during weird market events. So this was back during COVID, and this became disjointed, which makes sense. That was a completely odd time, and you can see it snap back, and this kind of decoupled from this Beige Book line. So what I'm saying here is, based on the Beige Book, based on its historical correlation with GDP growth is looking actually fairly healthy. So this is not signaling a recession yet. A recession is technically back-to-back quarters of negative GDP growth. And you can see we're not anywhere close to that, which again could change with the Fed. So inflation, so CPI, core CPI is still running hot. You can see we have 1 month, 3 month, 6-month and 12-month. We're tracking the trends. So inflation really fell off the map during COVID, really snapped back as things were moving towards getting back to normal. And then, due to the issues that we've discussed and everyone's discussed ad nauseum, inflation is still running fairly hot, but it has cooled a bit in March. As you can see, these lines starting to roll over a bit. And we did a post about peak inflation. We're not there yet, but there's signs it's starting to loosen up. But then you get stuff like China and their COVID zero policy. They basically shut down. That's affecting energy prices. So oil has come down a bit, but it's also affecting supply chain issues. And that should start to filter through the system in summer, which won't do the cost of goods any favors, right? If goods can't flow, if people can't get stuff, and demand is the same, that causes prices to go up. So there's all these wrenches and outliers and weird things that can affect this, but we're just doing the best we can with the data we have. It's really tough to forecast some of these random policies and random things that flare up. So looking at used auto prices, this has been a pretty good poster child, if you will, for hot inflation. And you look at 2021, where used car prices just shot up and stayed really high for the better part of a year. And this was due to semiconductors. So if you're building a new car, it's basically like a supercomputer full of semiconductor chips, which there was a huge backlog that caused the price of new cars to skyrocket because there was a lack of supply, and that trickled into the used car market. And that is starting to subside, right? So that's starting to loosen up a bit. You can see used car prices in 2022 have really fallen off, which is a good sign. So again, inflation is a messy, complex subject, and what we're looking for are signs that inflation has peaked. And there's no neon sign that flashes inflation has peaked. Inflation is backward-looking data, right? So in May, we're going to get April inflation data, and it won't be obvious that inflation has peaked until several months have passed, and there's a clear trend of inflation going down. What we're trying to do is sniff it out before it does happen. It's not like a sign flashes, peak inflation, and then these trades unwind. So there's going to be hints in financial markets. There's going to be hints with asset class pricing that inflation has potentially peaked before it actually peaks, if that makes sense. So this is a Google search, right? We can actually query Google, what people are searching for on Google. So this goes back to 2004 to present. This is as of April 22nd. And you can see the various spikes in recession, which is the blue, and this pink reddish line is actually inflation. So people are worried about inflation. People are worried about a recession. As we've shown before on our consumer sentiment numbers, consumer sentiment is in the dumps. People feel worse now than they did during the peak of the COVID sell-off, which is actually a good thing for controlling inflation, because when people feel worse, they generally spend less money. So some of these inflation narratives, which again, inflation is definitely a thing, but some of these narratives that are just extrapolating this out for the next few years are discounting consumer behavior and changes in consumer behavior. It's not like if prices keep going up that people are going to continue doing the exact same things. They're going to change their behaviors. They're going to trade off. They're going to find substitutes for high price goods. They're going to substitute them for lower cost goods. They're going to take less vacations. They're not likely going to seek risk. Like if you're thinking of moving or thinking of upsizing your house, you're probably not going to do that if you're worried about the economy. So this is interesting on multiple fronts. As you all know, we're fans of consumer sentiment. It contains a lot of really good nuggets that could help you make better investment decisions. So this chart comes from Cullen Roche, who is a investor analyst that I follow on Twitter. He's a really smart guy. He's starting to get nervous about the real estate market, and I'm starting to share some of those concerns. So what this is median home prices in the US divided by real disposable income. Okay. So what's happened here is home prices have continued to shoot higher. Disposable income has gone up, but not as much as real estate prices, right? So if we shock this and say home prices have doubled, but disposable income has only gone up by 10%, right? That's where you're seeing this kind of parabolic move in this line. So what this means is housing is becoming less affordable, okay? And there's a lot of different data points in housing, but the simplest metric is people need money to purchase houses. And if house prices infinitely go higher, people aren't going to have enough money to purchase houses. I mean, that's a simple explanation to a complex system, but I think it holds some merit. And again, we've seen this movie before. So when people don't have enough money to buy houses and they're stretched and they're taking on more and more debt to buy homes, it's unsustainable. And when you think about leverage, what it does is it widens your range of outcomes. When you lever up on your house and you extend to buy a house and it goes up in value, that's a great trade for you, right? Because leverage multiplies that good outcome. Leverage does that on the opposite side too. And that's this side of the side. So I'm not saying this is going to happen. Certainly underwriting standards have gotten tighter. Banks have gotten a bit wiser, but this is unsustainable. Home prices can't go infinitely higher forever. You throw in borrowing costs and rates are moving higher. I would at least expect home prices to smooth out, maybe dip a bit. Okay, and you're seeing this in the affordability equation here. So what this is, you can see on the y-axis here, as this blue line is going down, houses are more affordable. So this could be home prices going down, this could be rates going down. As this line goes up, houses become less affordable. Okay, so we saw a similar spike in the run up to 2007 and 2008. This is the current spike now as of 3/31, and you can see this spike is more violent than the rest of these spikes. So again, people need money to buy houses. Affordability is becoming more challenging. It's becoming less affordable for folks to buy houses. This is not sustainable. And this is a small graph, and you might not be able to see this, but really it's a supply problem. So this is supply here in the bottom left. As this line moves down, that means less supply. This is inventory, less supply, existing home prices going up. So demand's the same. If there's less supply, you get this, right? So something has to give. What's concerning is, right, if I'm a homeowner and I have a mortgage, which I do, and I think my mortgage rate is 3.25%, even if I wanted to sell, I would be disincentivized to sell, because if I sell now, I'm giving up that 3.25%, and I have to go out and get the new market rate mortgage, which might be over 5%, right? So that would cause me to do nothing. That would cause me to not sell my house. Even if, I have 9 kids and I only have a couple bedrooms and I'm stretched for space. Given the current landscape, I would be disincentivized to sell, because I would basically increase my cost of borrowing, my cost of capital. So I think that fact is going to affect a lot of people, and it's going to affect this inventory and supply number, right? Less people willing to sell equals less inventory and supply, which might put upward pressure on home prices. So it's a messy equation. There's no easy answers to what the Fed is facing, to what inflation is doing, to the housing market, to interest rates. This is just a very interesting time and a difficult time to be an investor. And all those things that I just rattled off could be a macro issue in and of themselves. We're getting all of these things converging on each other. So it's impossible to know what happens next. There's no playbook for what we're dealing with now. Anyone that says they know what happens next is full of it. The key is to be open-minded, to be flexible, to be nimble, to have a process for managing risk, because it really is easy to make emotional decisions in this environment. It's easy to abandon a long-term investment plan. There's a lot of noise. There's a lot of information coming at us. It's very important to have an information filter, to have some really good sources that you trust, that are reliable, that are unbiased, that are objective, to get information. I can't stress that enough. It's probably the most understated thing that we talk about. It's not talked about enough, but having an information filter, because I find people make horrible decisions when they're absorbing all of the information and they can't filter out what's nonsense and what's garbage versus what's actually meaningful. So this has gone on long enough. I'm rambling. Thanks for tuning in. We covered a lot. Feel free to send me questions if you want me to clarify. I know I talk fast, and always open to feedback as well. So thanks for checking in. Take care.